What's going on, guys? Welcome back to my channel. This is Blood Phantom 81. So in this video I'm going to be talking about my losers. Now, losers is often a term to define stocks that someone is currently down on, and I don't necessarily like the term losers, and so I'm going to address them as stocks I'm down on. The reason being is because I don't intend to sell these stocks in the near future. There are a lot of stocks that I sort of wanted to try out value investing on. And by value investing, I don't necessarily mean like what it sounds like. I know that if you search like value ETFs, for example, you're not going to find stocks that are multi-baggers or potential for multi-baggers. You're going to find, energy stocks or financial stocks, basically stocks that are usually large cap that are just, not really in favor with the market right now. And so that's kind of how people define value in today's terms. But in my sort of point of view, when I think of value, I think of multi-baggers. And that's more along the lines of what Peter Lynch and Warren Buffett and uh, Benjamin Graham, I think is his name. I don't want to say like Benjamin Franklin or Graham Stephan. I think it should be Benjamin Graham. So, yeah, anyway, so like the Godfathers of value investing, basically what they were after really large returns, right? And so that's kind of how I think about value investing. And the funny thing is that, so along the lines of value investing and fundamental analysis, all the stocks that I'm talking about today fall along those lines, where I essentially take, let's say, 20 to 40% of my portfolio, usually only like 10%, but I've been sort of increasing the allocation. So let's say about 20 to 30, maybe at most 40% of my portfolio for a lot of hyper growth stocks, a lot of which happen to be stocks that I use fundamental analysis on. And so it's just like a muscle that I'm starting to flex a little bit more. And the funny thing is, they actually tend to be my worst performing stocks, the stocks that I do fundamental analysis on. And value investing as a whole is sort of tricky because you essentially say, hey, here's this stock that I think is trading below fair value or is in an industry that's set to grow or is currently growing. Maybe they're out of favor right now. Whatever reasons that you like in terms of actually defining value investing doesn't really matter. There's this idea that, hey, I know something, or I think I know something about this business, and I think this business is set to grow based on various factors, right? And the interesting thing is that with a lot of multi-baggers, these generally are a lot different than the kind of stocks that Warren Buffett talks about because they don't actually make profit, a lot of them. And so it's sort of like a more hybrid approach to value investing, I would say. A lot of people would call it speculating, and I wouldn't necessarily disagree on that. So anyway, where I wanted to get with that is that value investing, you essentially buy this thing that you think is undervalued by your terms, and then you just kind of wait, right? You wait until the market catches up to what you consider to be reality. And so, in that sense, it can be a very dissatisfying investment philosophy, right? Because you kind of just, there's not much you can do there. You do the research, you put your money in, and then you wait for the market to catch up. And so that's something that I've been trying out. Obviously, it could work out beautifully, right? A lot of people make a killing of this strategy of investing, but a lot of times, often you may potentially miss out on opportunity costs. And so the best investments that I've made so far have all been through technical analysis, trend following, etc., right? Because I look at what's trending, like let's say a Facebook's crushing it, or let's say a Google, and I look at opportunities and I just kind of ride the wave, right? And so like no fundamental analysis required for that. The last thing I'll say before we get started is that this video is actually inspired by a fellow subscriber who commented on one of my channels recently. He's actually a new subscriber. So Tim D says, excited I found your channel. I totally agree what you said about 80% of financial YouTubers. And obviously this guy watched the entire video, which is very flattering. He mentioned that there's a specific YouTuber who is not the best investor. He was YOLOing into GoPro and losing badly. Then he bought some washer dryer company for dividends. I remember that. I remember both of those in his public portfolio, but sold like a month later to make it look like his portfolio only had winners. And on YouTube, it is very, very easy to sweep your failures under a rug. Now, again, I don't like to say failures or losers because some things may take a little bit longer to pan out. But I think it's okay to start consider something a loss once you make that investment, you sell out of that investment, and then you give up on it. I think that's considered a loss, and you never look at it again. So I was like, why don't I talk about some of the stocks that I'm down on that I actually have talked about on my channel before? So let's jump right into my quote unquote losers. All right. So first on the list is Protolab. So this, you can obviously tell that the amount that I'm down on here is much larger than the rest. So like, for example, my second biggest loser at the moment is actually Skills, which I talked about on this channel. I said this is actually one of my favorite stocks to own. I still like it, but I'm currently down 2,000. And so we're going to talk about each of these actually. This is basically the biggest 2, 4, 6, 7 losers. How appropriate, because my favorite number is 7. All right. So first on the list is Protolab. So what is Protolab? So Protolab is essentially a 3D printing company. So proto is the first word in this name. It's basically short for prototype. So Protolabs basically creates 3D printed prototypes and custom parts. So it's not necessarily something you go to when you want to order large scale parts, but if you want to create a prototype or a model of a new idea that you have, especially in manufacturing or industry, then you go to Protolab and then you can actually print out what that would look like. And their turnaround time is actually in like 48 hours or less. So you basically have an on-demand supply of 3D printing parts. And so it's kind of a niche business model in the sense that, again, you don't go to them when you want to order at mass scale. And they don't really sell 3D printers like other manufacturers do, which actually like, I don't have it here, Stratasys, which I won't be talking about. So Stratasys, for example, does have their own 3D printers that they sell. That's their business model. Protolab actually sells the parts, right? So you don't actually have to buy a printer yourself. And so let's talk about them from a technical perspective. All right, so Protolabs is currently at about $71 per share, and we're sitting right here at this trend line. And so they've been public since 2012. So it's basically about 10 years of history, always above this trend line. And it sort of looks like we're spending some time below it. Now, I don't think this is the end of the world. I'd be curious to see what happens over the next couple months or so. And it looks like we still haven't broken below this high. So it's still a series of higher highs and higher lows. And so the all-time high here is about 290 or 285. And so currently at about $70 per share, right? So, I mean, if that makes any kind of difference, we could 4x and barely be at the all-time high, basically. This right here is a perfect example of me liking a business model and continuing to invest in it and basically average down. Now, let me make one thing clear. I don't feel bad about my position size. I'm not even bummed out about the fact that I'm down about 6.7K on it. I just wanted to sort of call this out to say that, like, sometimes investing hurts, right? Sometimes you like a company. I started buying it since the 200-day moving average, honestly. Sometimes you like a company and it just keeps on going down and you keep on averaging down and your loss gets larger and larger and larger. But like I said, I don't regret buying this company, and I'm still going to hold it for the long term. And I think in terms of what would make me sell or rethink this would be if we lost the low here. So then this would no longer be like a series of higher highs and higher lows. If we lost this low here, it would sort of point to me that perhaps buyer demand isn't really there. And I would sort of just watch this area, actually. I'd watch this low and then see if we can get back above it. And this would basically be my stop loss as well as like my level to potentially re-enter if we can actually reclaim this low, and then sort of just watch it from there. So that's Protolabs. Next on the list is Skills Inc. Don't have to go over it too much because I already had like a super in-depth video about it. But basically, Skills is pretty close to where it opened at, around $10 per share. So Skills is basically a mobile gaming and game development company. They basically pair with developers to create a competitive marketplace that users can actually pay money to compete in tournaments. And they have like millions and millions of tournaments going on all the time. And so yeah, anyway, so Skills has a lot of work to do, I think, in terms of their actual business model and growing it to more games. From a technical perspective, again, we are basically right back where we started. And so I also don't feel bad about this position. Now, let me just say something real quick before I forget, which is like, you notice that like even this is my largest loser right now, which is Protolab. This is still $6,700, which isn't, it's not great, especially because my position is now worth about 11,000. So it's not great, but you know, this is not that much. My portfolio is in the 400,000s right now. Like that's fine. And same thing with Skills Inc. Like I'm down 2K, like my largest winners, and because I swing trade so often, like I don't even have them anymore, but like sometimes I'm up like six figures on a position, and so it doesn't really matter to me if I'm down 2K or 1K or even 7K on a position. That's just part of the game, right? This is the cost of doing business. And so that's Skills, Hylion. I like that Skills and Hylion were back to back, because what I really wanted to talk about here is the fact that they look so similar, right? Don't their charts look extremely similar? IPO'd here at around $10 and then just had a massive run up, basically like 4x, 5x, and then now we're back to where we started. And so the same thing can be said about Hylion. So the timeline is a little bit different, but even just the way they've been acting in the past few months is pretty similar. And basically with both of these companies, they are getting hit hard by the anti-speculative and anti-SPAC sentiment that's been plaguing the market recently. Now, these are both still great businesses and business models, in my opinion. For example, Hylion, I think, is probably like the only true solution right now for what they're trying to accomplish, which is alternative energy for the trucking industry. I think they have that figured out, and I think they're the leaders. And then Skills, their margin is just fantastic. Obviously, they spend a lot of money on marketing, but I think they can figure out some stuff to basically continue growing. And so both of these are getting hit pretty hard, and they just happen to be in the same industry. And let's go ahead and take a look at something like ChargePoint, right? Which is no exception, basically, also getting hit pretty hard. And then let's take a look at something like SoFi. Again, no exception, except SoFi actually crushed it recently. So I take that back. SoFi is actually an exception. But anyway, the point is still the same, which is these stocks are getting, dragged through the mud. But the great thing is that these stocks are also like less than $3 billion market cap, and so that's going to help them grow, basically, because they're not that expensive relative to what they could be. All right, so next on the list is Invitae and CRISPR and Twist. So these are all genomics companies, and these are 3 out of the 4 genomics companies that I truly like. Let's go ahead and take a look at Invitae. So Invitae is probably the most consumer-facing genomics company at the moment, at least like from a pure genomics perspective. So they basically do DNA testing. So you take a test, they send you like a test kit, you spit in a tube, and you send that DNA to a doctor, and then they have a lab that will process your results and tell you if you're predisposed to any particular disease, or they'll also come up with like a personalized healthcare plan, especially if you do have something that you need to worry about. And so basically helping transform the healthcare industry from a super general blanket statement approach to now a super personalized, ultra personalized approach to actually staying healthy. And so, yeah, Invitae, if I look at this from a long-term perspective, like this is exactly the kind of place that I would want to be buying at. And so obviously, like, lots of support here around the $27 area. Now we're consolidating above it, and we also have the 200-week moving average right below that. And so I don't feel bad about owning Invitae. Even though I'm down on it, I would actually consider buying more. It just so happens that like I'm trying to be a little bit more conservative with my cash, but if I had more cash, yeah, I'd probably put it in Invitae. And so one thing I want to talk about here too is that Invitae is actually more closely aligned to a business model from a value investing perspective versus the next company, which I'll be talking about, which is CRISPR. CRISPR, if you invest in CRISPR, you're investing in hope. Now, what do I mean by that? I mean, they don't, they're far from making a profit, and the revenue that they do bring in is super sporadic. Like they're constantly getting funding. Like this is a massive scale science project, which is actually pretty successful, who someday, most likely one day, will in fact, I think, revolutionize the healthcare industry from a genomic perspective. And so CRISPR Therapeutics basically uses CRISPR-Cas9 technology to essentially edit genes. And so if you have a deformity in your genome sequence, CRISPR can actually replace or fix any one of numerous problems. And so the list of use cases for CRISPR just keeps on growing. And as of now, they're mostly focused on sickle cell disease and other blood-related hereditary diseases. But again, like that's just a start, right? So CRISPR, again, you are investing in the idea that this could one day actually do everything they're researching right now. And I don't think that's kind of a far-fetched idea. So I like CRISPR. I continue to invest in them. I think they're actually my largest genomics position. I mean, it's larger than Invitae, that's for sure. And Twist as well. But anyway, so speaking of Twist, let's go ahead and take a look at Twist really quickly. And again, one thing I really want to highlight here is that Twist had a fabulous run since March 2020, since this crash happened, just like astronomical run, right? We're talking $18 per share, all the way to $200 per share. That is a legitimate. I'm not exaggerating. That is a legitimate 10-bagger. That is now pulling back, right? And obviously, all the boomers are coming out of the woodwork talking about, see, I told you, ARK stocks can't keep going up forever, right? See, haha, S&P is outperforming. My boomer stocks are underperforming in the past few months, whatever. Yeah, say that all you want, right? But in terms of potential over the next decade, like, come on, it is not even comparable. Even if Twist needs a little bit more to consolidate, like, when we're talking about high upside, I'm talking 2, 3, 5-bagger, 10-bagger in the future. I'm looking at companies like Twist, and so Twist Biosciences is another favorite of mine. All right, and so the last company I'll talk about is Fastly. So Fastly, I actually made a specific video about, like I called them out saying, hey, I actually like Fastly, I'm buying it. But my sentiment towards Fastly slowly started to change. Now, no coincidence that I own about 100 shares of Fastly, right? I added about 15 more recently, but I own 100 shares. You already know what that means. Covered calls all day. And so for now, they're kind of just like an income producing asset that I'm actually down on. But my overall sentiment towards Fastly has in fact changed. I'm not as crazy about them as I once was. That doesn't mean that I want to get rid of them immediately. It just means that at the moment, between Fastly and Cloudflare, which are both content delivery networks, it is just no comparison which one is the superior business, in my opinion. And so, yeah, I think Cloudflare is at least 3 times the company that Fastly is, even if it is a little bit more expensive right now. I mean, who cares what expensive actually means? I mean, if you're killing it, then you're gonna keep on yeah, you're gonna crush it. All right. So that's where I'll wrap up the video. I'm sure this video got quite long, but yeah, I kind of just wanted to go over my, again, I don't want to say losers, but stocks I'm down on, just to say that, like, hey, like, I'm not scared of calling out the stocks that I'm down on, right? Like, it's not all, rainbows and all that stuff. Like, I'm not up on every single stock I own. Like, it happens, right? It happens. And again, I'm not the best investor of all time, right? So, I mean, yeah, stuff like this is going to happen. But it depends on, like, hey, why do I buy this in the first place? And like how to have the best attitude going forward. And like just being more strategic, I think. And that's how you become a better investor. So anyway, that's where I'll wrap it up. Thank you guys for watching, and I'll catch you in the next one.